This morning we did some recessionary analysis, and TS Lombard, who's been a bull, is still a bull on soft landing, but they're seeing some cracks, and they give you an outline of what to pay attention to. It is worth noting that so far, I've been studying the earnings calls of a lot of different companies, and while the International Monetary Fund doesn't see a recession on the horizon, although they do suggest slower growth, and even companies like Paychex don't see indicators of a recession at the moment, it's worth noting that a lot of these businesses refuse to tell you in advance if they think a recession is coming. Because usually if one company is like, yeah, we think a recession is coming, people think that company just sucks. And then they sell the stock. If people don't think a recession is coming and they're like, there's no recession coming, people might be more likely to buy those publicly listed stocks. So I think there's some, reading in between the lines you have to do with a lot of these companies. And you're finding the general theme now is slowing and uncertainty. Now we're going to see some things to look for from TS Lombard regarding the brittleness of the economy. But it's also worth noting this morning, Bloomberg Intelligence suggested that Q4 was peak for global earnings growth, as now tariffs have increased volatility, sky-high AI earnings growth is slowing, and higher rates start to bite. Now, obviously, we could get a lot of enthusiasm that rapidly comes into the economy if Donald Trump ends up striking tariff deals, which we'll separately talk about some tariff deals that I think could be on the horizon. But first, let's talk about TS Lombard and some of their data, which is quite interesting, as well as considering that while JP Morgan is seeing some deceleration in spending growth from consumers, they, on their card platforms, are still seeing growth of around 2.6%, with Gen Z and millennials really driving most of that growth, Gen X and boomers really accounting for almost flat growth to slight growth. JP Morgan, it's worth remembering, is a much harder credit card to get access to, or any of their cards are a lot harder to get. They're not going to really appeal to lower credit scores, lower income individuals. They're a little bit more of like a bougie bank, if you will. So it's worth noting they're not I think, best cross-section of America. They're a little bit more of the bougie cross-section of America. That's my take. And yeah, we bank with JPM, sorry. But anyway, let's go into just worth knowing that, because I remember being 18 and applying for credit, and it's impossible to get credit from JPM. And it took years to get in. You'd have to go to, Wells first, or Citi, Discover. Those are usually your founders. So everybody goes through it. But that's a note from JP Morgan. And now let's take a peek at this TS Lombard piece on the brittleness of the economy, because they're going to give us some more insights into this slowing as well, in their opinion on this slowing. So let's take a peek of this. So Trump 2.0 is proving a lot less reflationary than the consensus assumed, with the threat of tariffs and DOGE spending cuts undermining confidence. We think the U.S. economy can withstand these shocks. A soft patch is likelier than recession, but budget consolidation is risky without a monetary offset, so it'll be important to monitor the labor market. So we need to explain this. And there's a lot of detail in this, so we're going to go through this and see this here specifically. So what do we have here? While we would not describe the latest U.S. data as recessionary, they see a growing sense of anxiety about where things are going, and they think the most important place to watch is the labor market. I just want to remind everybody, the problem with the labor market is it's very, very slow to give you any kind of leading indicator. In fact, it's more likely to provide you lagging indicators than any kind of leading indicators, which is quite unideal. I'm trying to find where this comment is. That's okay, we'll find that later. So we'll go through this line by line here. Oh, it's stupid Apple, that's why. Zooming in my pages like this. Okay, there we go. Today, the sense of optimism that we got from Trump has disappeared. And there's this question about, hey, are we just unwinding the animal spirits of what Trump brought us with the election? Or are we going to see more of this, where this is more than just a reversal, and is there potentially more damage coming to the economy? And their point of view is nobody expected Donald Trump to inflict pain on the economy. In fact, they go as far as saying that they thought, as well as a lot of people, that Donald Trump would be arbitrated by the stock market. Now think about that phrase for a moment. It's a really interesting phrase. An arbiter is a form of a judge, right? But it could also be somebody who sort of dictates proceedings and how things are to go, right? So imagine this arbiter over Donald Trump. No, Trump. Don't. Here, hold on. We need a prop. No, Trump. Don't do that. The S&P 500 is going to go down. Okay, that's what people thought was going to happen. The reality of what we've been getting is, hey, Trump, did you see the stock market is down 2%? Huh? What? Today or in general? No, it's down 2% today. It'll sort itself out. That is not the Trump. That, by the way, is exactly what happened yesterday. That's not the Trump markets expected. And T.S. Lombard is basically saying this is an adjustment for markets. We don't have somebody who's bound by what the stock market is doing. And this idea that we have essentially a government that's willing to inflict pain or detoxify the economy is a risk. And so they provide 3 recession risks, even though they are not forecasting a recession. They say, first, we don't have a monetary offset. This basically means we don't have JPOW printing. Okay? Easy enough. Number 2, they think the combo of DOGE and tariffs is dangerous because DOGE creates negative fiscal spending to the extent that it's successful, and tariffs encourage the Fed to hold because of the inflationary risks. In addition to that, while the broader private sector is really healthy, including larger businesses that are doing very, very well, small to medium businesses have really big risks, and the risk is increasing. It's worth remembering that about half of employment in America is small business employment. That's a really big deal. So now they argue that 3 months after the election, it's really hard for investors to start dismissing the bad, especially since tariffs, deportations, and DOGE are happening now, whereas tax cuts and deregulation won't happen until 2026 or beyond. How funny. If only there would have been a YouTuber that told us, be careful, the good that Trump is bringing you isn't going to hit until 2026 or later, and the bad is going to hit up front. And you should be really careful of Q1. Oh, that's what we did. It's okay. Sometimes you got to pat yourself on the back a little bit, but we don't want to get cocky here. Nobody's perfect, and we don't want to crash. I know some people do because they think it's gonna be good. Let me put it this way: no economic recession is good. Everything sucks. It doesn't matter. So anyway, okay. So what else do they say here? Optimism giving way to genuine investor alarm. If so, why? So basically, they're arguing here that authorities within the Trump administration, when it comes to tariffs, are basically going beyond this, hey, we're going to use them as a negotiation tool tariffs. There's actually this, they call it an ideological belief that the Trump administration is going to go all in on rebalancing global trade. And that the ideology is the world must pay for America's taxes. And that this is not just a short-term pain or detox because, after the Biden admin, but rather this is some long-term transition that's just not going to happen overnight. T.S. Lombard sees that as a longer-term risk because they say here, short-term pain is a real possibility and the promised long-term gains are speculative and based on specific political ideology. Now, this is really interesting because it's a way of essentially saying, hey, if you're MAGA and you're all in on Trump, it'll be fine. Great. But it usually isn't. Because when things in the short term start compounding in a bad way for longer, you end up, quote, feeding on themselves, these issues feed on themselves and can even leave long-term financial scars. They write this. Does anyone seriously believe, for example, that an economic downturn would lead to an improvement in public finances? Spoiler alert, no. They're going to print money and we'll be in more debt than we ever have been in before until the entire financial, monetary system collapses and the economic Ponzi is over. Now, I don't think that is imminent. I think it'll be in a few hundred years. It'll happen eventually, but I don't think that is imminent. That's just my opinion, though. But I also don't like holding cash. You know what I really prefer over cash, and we're going to keep going with this recessionary article here, although they're more of a soft landing argument, is house hack. That's because I think diversifying to real estate is exactly what you want to do right now, and here's a 45-second pitch on house hack. Go, roll the ad. Hey everyone, me Kevin here, CEO of HouseHack. If you want to diversify into real estate, go to househack.com. We buy the real estate, we manage the real estate, we deal with all the tenants and toilets for you. And look, we have a beautiful website. You want to invest? You can now even invest as an accredited or non-accredited investor. You get 100% of the upside. You get paid a 5% yield with all the upside of the company's stock, and we do all the work for you. If you want to see or learn more about our investment offering, our offering circular or PPM if you're an accredited investor, or what it is that we do, or pictures of the properties that we own, some of our finances or whatever, make sure you go to househack.com. Now open to accredited and non-accredited investors. All right, ads over. How was that? I think it was good. Now, let's go to this piece again. Cool. The reality is that once a recession starts, nobody knows just how bad the situation is going to be or how long the downturn will last. And once US unemployment starts to rise, it usually rises a lot further. There is no doubt recent US economic data has been soft, particularly compared with bullish expectations. The macro surprise index plunged at the start of the year, retail spending has been subdued, and confidence has clearly deteriorated. It seems that uncertainty is encouraging businesses to postpone hiring and investment decisions, while talk of economic pain is never good for consumer sentiment. You know, I heard this is just an anecdote, but I heard somebody was applying for a job, and I was hoping they'd get it at like a certain Mag 7 company. And apparently for that job, there were 1,500 job applicants for the same damn job. I'm like, oh no, this is a fundamentally bad thing, especially when people that I actually think are quite smart, high IQ, high effort, high energy individuals who deserve the job can't get it because of macro. That's what pisses me off, because now, like, that's why I say you shouldn't cheer for a recession, because you can be the smartest person in the world, you can have the best skills or talents in the world, but the data just gives you a middle finger, and then it's like, bro, this is some bull. Now, that said, so far, we've been doing okay. I mean, if you look over here, as they say, the labor market has been stabilizing back to 2019 levels. When we thought payrolls were slowing down over here, we bounced both times. We've had a slowdown. So maybe this is all part of just, an adjustment phase or the normalization phase. I don't think so. But that's what a lot of people think, and that's okay. Maybe that it will be like that. I hope so. That would be Goldilocks, right? Here's your Challenger job cut layoffs chart, and here's their thesis on DOGE. So their thesis is DOGE will fail. Now, they make the argument that DOGE will probably not cut anywhere near as much as they're capable of cutting because their wall of receipts has been mostly fugazi. But let's say they're even remotely successful. Losing 300,000 workers at the federal government would equate to an extra 20 basis points of the unemployment rate, which in a healthy economy, the private sector should be able to absorb. But the job losses will be larger if we take into account the shadow government employees, contractors, or those who depend on government contracts and subsidies. Since there are 2 shadow workers for every federal employee, that could bring the total job losses to over 800,000, or an extra 50 basis points of unemployment. And that's where things start to get interesting, because why, as they say? Well, it triggers the SOM rule again. You remember that false indicator that we got in August, and then we revised away the SOM rule? Well, usually when we actually break the SOM rule, and we're not just revising it away, thanks Biden, we add 50 basis points to the unemployment rate over the last 12 months. Low, 3-month moving average low. Then what happens? Well, once that joblessness increases that much, it usually keeps rising by likely another 1.5 percentage points or more. We also know that the jobs market is currently in a fragile equilibrium. I agree with that. Both layoffs and hiring at very low levels, which means that former federal employees might find it hard to secure new roles, and it won't take much of an increase in layoffs to unsettle the current equilibrium. This is the thing. This is why Jerome Powell, people listen to J. Powell and they're like, oh, he sounded dovish. And I'm like, Did you pay attention? He literally told you to your face that layoffs are the last line of defense. We are literally at war with the economy. And the last line we have in our tower defense of the economy is a low layoff rate. The second that low layoff rate breaks, it's like a levee. And that unemployment rate skyrockets fast because then it becomes normal for businesses to announce layoffs. Roughly half, it's like 45% of our labor market is built by small businesses. Small businesses are getting hosed right now. Small to medium are screwed. It sucks. You know, does Apple give a flying hoot or Berkshire Hathaway? Nah, they have more money than God that they're sitting on. Fine. It's because God doesn't believe in paper currency. In fact, he told me that he believes in HouseHack and investing in diversifying to HouseHack. HouseHack.com, sponsored by God. All right, where were we? So here we have a government decision to trim the size of the workforce. So what they're saying is normal recessions have their root in some form of fundamental or like underlying macro financial imbalance. And then that's where things become unstable. And then there's a painful adjustment phase that gets triggered. Here, this adjustment, they say, is sort of more like self-imposed. It's basically a, Trump move that hopefully does not turn into a spiral. Because if this is enough of a tipping point to trigger a broader private sector retracement or retrenchment with jobs, you have to be careful, basically. So in other words, let me rephrase this. If job losses are bad, and the private sector picks up those jobs, or even city or local governments do, or state governments do, not that bad, no spiral. But if the government layoffs spill over into private layoffs, especially in that small and medium sector, you're screwed. This is bad. Now, obviously, tariffs are already impacting and slowing down spending. Best case scenario is companies just pay the tariffs and we move on. What else do we have here? I really hate that this is not a progressive scroll. There we go. Oh, thank goodness. Oh, that's so much better, Apple. Who would ever scroll by page? If you're a page scroller, leave a comment so I can make fun of you. We need continuous scroll. Anyway. All right, so where were we? All right, here we go. Consumer confidence, minus fewer job opportunities. If this breaks lower, it could signal recession. Okay, not a good chart. Got it. It would be a stretch to say the economy is already turning to recession or that such a downturn is inevitable. Right. So in other words, it's not a foregone conclusion that we're definitely screwed. It's just starting to smell like we're screwed. I kind of agree with that. Like if I thought we were definitely screwed, I'd be a 1 on the bear bull scale. I'm like a 2.9. I have some hope left. I'm like, maybe Trump will make a deal with the Canadian Prime Minister or, Claudia Sheinbaum of Mexico, whatever. We'll talk about that soon. But anyway, let's take a look here. Again, with this back of the envelope calculation, we're not taking a recession-sized hit to the economy with potential DOGE-related layoffs. Muck around and find out. Okay, that's like a reference to Musk. Hidden vulnerabilities. U.S. households and corporate financials show a surplus. And it's rare to see this, going into a recession where everybody's got good cash flows. But the trickier question is, are we hiding vulnerabilities? And the vulnerabilities to pay attention to the most are here. Outside of superstar companies, which may be flattering the aggregate data, many small to medium enterprises are struggling. If Trump's policies prevent the Fed from cutting interest rates, those companies will face an additional monetary squeeze over the next 12 months, with debt servicing ratios set to rise. Poopy doopy. So, what's the bottom line? Well, T.S. Lombard says a soft patch seems much likelier than a recession. Well, just keep in mind, this is me adding my own little salt. Salty, Kevin. They were really bullish a couple months ago. Sorry, I actually do respect the T.S. Lombard folks. And I think this is, this isn't like a mea culpa, but this is a reasonable response to the data. So Dario Perkins, you perked me up with this one. I think you're aligning I think this is a very fair take, and I think it is entirely fair to be more bullish on soft landing. You know, maybe if he had a bear bull scale, he'd be at like 6.9, okay, 69, and I'll be at 2.9, all right? Fine. Everybody can have their own opinion, right? This is not like an on or off light switch where it's yes recession 100%, no recession 100%. It's you know, degrees of certainty, and we'll see how things evolve. But my concern is that their monitor, what they want to pay attention to, the labor market, is just going to lag. And by the time the unemployment rate goes poopy doopy, which, you know, could happen within the next 6 months, it's too late. Stock market's already going to be mega freaking pissed. So we'll see. I actually think that's one of the reasons we keep seeing these fades in the stock market, mind you, because I think people are realizing that there is actual weakness coming, that this isn't like some clickbait over, oh my gosh, it's definitely going into recession tomorrow. You know, this is all about odds and being prepared and then keeping an eye open with perspective. So that way you in your life can look around and go, okay, you know, like, how do I actually feel about my debt situation or my cash flow situation? Am I diversified enough for this? The whole point is just to give you a little bit of a heads up so you can kind of start thinking to yourself, all right, you know, yeah, these are issues. And some of the, you know, staunch bulls are turning a little bit more bearish. Now, my favorite time to invest is when all of them are mega bears. You know, when all of the institutional analysts are like, this is the worst ever, it's never gonna get better. Great time to invest. Mostly, I think that's true because I remember back in 2022 when I launched, you know, my fund, I'm like, dude, we're launching this at the bottom of the market. This is great. Everybody's so bearish. People are like, why are you getting into that? And it's funny because I purposely, in part, closed it in February because I'm like, I think we're about to fall off a cliff. So I handed people basically a giant egg of cash that had grown in value, you know, 24, 25% or whatever it was since December of 2022, which is pretty good, you know, for the 2.5 years or whatever it was up. That's including the hedging that we had to protect against the downturn. And sort of like, hey, I think things are about to fall off a cliff. Here's an egg of cash. Good luck. You know, we grew it. I mean, I think that's quite interesting. In terms of macro timing, and it gives you a view of where my head is. But maybe I'm too negative. I hope I am. And you know, so you know, maybe it'll turn out that being a 2.9 on the bear scale was just too bearish, and I should have been around a 5, or maybe I should have been with Dario at, you know, whatever 6.9 or whatever he's at. Everybody should have a bull. We should all have T-shirts that are mandated. We walk around wearing those T-shirts, and they tell everyone what level bull bear you are. So when Peter Schiff walks in and his is at 0, you know, because he's that bearish, well then we know the sort of the disposition, and then we can listen to why. Anyway, congratulations, by the way, house hack. Yesterday, the house hack investments exploded. I'm looking at it right now. I'm like, man, we didn't think we'd break those numbers this quickly. So pretty impressive. Again, I think this is what we're seeing is we're seeing a fading of risks in the stock market. People are diversifying to other opportunities. Anyway, all right, good. That's that.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.